Hello and welcome to the Sales Leader series. I'm your host, Freddie, where I'll be gathering B2B SaaS sales leaders from across the world to answer 5 short, topical B2B SaaS sales questions. These questions are going to be the same each week, bar one, giving you insight and different perspectives into how top performers within the industry think, as well as actionable advice you guys can use in your own selling careers.
This week on the Sales Leader series, I'm talking to Seamus Ruiz-Earle. Seamus, not having planned to be in consulting or RevOps, started his career with aspirations in investment banking. After searching for experience in high school and having only been met with dead ends in IB, he was offered an opportunity by Prager Co, one of the banks that he'd initially reached out to. Like other firms, they were apprehensive of giving him a client-facing role, too young, lacked experience with regulatory issues, but what they did need was someone to set up their CRM. While working for Prager and still in college, Seamus became the youngest Trailblazer in Salesforce history, speaking at Dreamforce when he was only 18. Having developed the skills, experience, and hunger in implementing software and RevOps, Seamus decided to have a crack at consulting himself. Fast forward to today, and after just 3 years in business, Seamus is the CEO and founder of the Carabiner Group, a very well-recognized revenue and sales ops consultancy firm based in San Francisco, helping high-growth tech companies, financial and educational institutions set up complex CRM configurations and develop RevOps sales ops strategy. Seamus is also a valued founding member within very well-established revenue communities, which I'm sure many of you would have heard of, such as Pavilion. Seamus, that was a bit of a mouthful, but look, thanks for coming on the show.
Absolutely. Thanks for having me. I appreciate being here.
Yeah, we had Cliff, your CRO, on the show previously, so this is going to be a nice follow up.
Well, I'm always happy to spill the beans on what Cliff's doing. Right. The nice part about getting the boss on afterwards is we can fact check and tear some of those assumptions apart. Right.
Exactly. Don't tell Cliff. Let's start with one of the things that I didn't get to ask Cliff in particular, and this is something that I know of the Carabiner Group anyway, is I know you and the team work very hard on creating customers for life. What makes Carabiner different, and how have you fostered a buying and customer success experience, if you will, for your clients that last?
Well, I do think there's a tendency in startup world to create products that don't actually solve problems, right? When you think about the product ideation motion, where it really should begin and live, in my opinion, is it's grown from a problem that you felt or experienced before. Maybe not yourself, but at the very least, you need to do, venture studio-esque sort of discovery model, motions with your customers, right? Or your potential customer base to really understand what is it that they're looking for. Or maybe not even what they're looking for, but what are the problems that they're experiencing, and reverse, engineer your product to solve those problems rather than the other way around, right? Creating the product and forcing it to solve problems that it may not have originally been designed to fix. That is even more poignant, right? More prescient in the space of services, right? Because service offerings are very much catered to your customer base, and too often folks just take sort of the bread and butter, the standard of what has been said already, and take that as gospel truth and model their own firm after it. And so we did the opposite, right? The way we created customers for life was we actually looked at, okay, what is it that they need, and what is the best service offering that can actually work well for them? And, broadly, the industry today and what it was 3 years ago as well when we started, was typified by 3 major characteristics. One was very high hourly rates. The second was short-term project-based engagements. And the third was a near universal, and I won't say this is 100%, but let's say even as low as 50%. 50% of project engagements ended unsuccessfully because of those first 2 elements, high dollar values and short-term projects with very strict statements of work. And we looked at that and said, well, if you could, work with someone for 3 months and make $50,000 profit and continuously fill that up and not really care about their success afterwards, we understand the financial motivation for doing that, but that customer will never be a customer of yours again. unless you deliver the work product. And it's almost impossible to do that in that period of time with those sorts of margins. So instead of taking that approach, we said, well, what if you split out that whole profit margin over the course of a year, right? And said, hey, we'll work with you for a year, really be in partnership with you and making sure you accomplish, what you're trying to get to, lower our margins on the short-term work and really make it over that first year. But with the kicker being that we're always gunning for that renewal for the next year and the next year after that, right? So we effectively lengthen our lifetime value. That's our benefit, more revenue in the door, albeit at lower margins. But we also get to deliver a much, much higher degree of customer satisfaction because we don't need to do change orders. We're not scalping them at the nose for the hourly rates. We're making it something that's sustainable and tenable, which particularly for folks who are going through periods of change, whether they've raised funding or, God forbid they have to, scale down or scale up, right? Like we're all in a really weird time right now from an economic motion. For folks who are going through that period of change, not having limitations on your support really, really goes a long way, whether that be technology or scope of what we're actually working with on the clients. So that's kind of how, my philosophy around customers for life. We have customers now that have continued with us. My very first customer is still a customer, right? My second customer, my third customers are still customers. And that's a pretty gratifying feeling when, you see a lot of churn in this space generally across the marketplace.
Yeah, makes sense. And I'm curious, because you've been running and founded Carabiner only short 3 years ago, right? Coming out of Prager and starting up your own consultancy firm, SRE. Is that something that you were conscious of when you started and came out of Prager? Or is this kind of an evolution of you looking at the consulting and services industry over time?
Not even in the slightest. So I started at Prager when I was 17, right? And I was doing it part-time while I was in college. And the intent was always to do the investment banking side. It was never to be a consultant doing the operations bit. This was just the only job that the SEC would allow me to have because of the regulatory compliance issues. So, along the way, I realized I really liked doing this work. I liked it more than I liked doing the financial analysis, and I was getting greater levels of access. But the intent was never to start my own company. The intent was always to go and work for a big firm and, stay there for 20 years, make partner, be the old grizzled bear on the wall sort of thing. Right. And that was the path I was on. I got recruited out of college by Deloitte. And was really excited to start. And then the pandemic hit and my start date was delayed by 9 months. And I had 9 months and 90 grand in student loan debt and I needed to, pay some of that off. And so I said, well, why don't I just keep doing this consulting thing I did all through school and see if I can, pay off my student loans was sort of the goal. And so that was where I started. And then the traction just happened within 2 or 3 months. I needed to hire three people to support the level of work that I'd been doing. And the rest is history, as they say. So it really wasn't ever my intention to start a business myself. I've always loved business. I've always been really engaged and involved in the community, but I always thought I would be, a cog, albeit hopefully an important cog, but a cog nonetheless in one of these bigger firms and bigger enterprises.
Makes sense. Over, I guess that 4 to 5 year period, I can imagine during SRE and now obviously in Carabiner, you've been working with large institutions across finance, tech, weekly, right? And I can imagine you're often under the hood more than most in all of those different aspects and realms. Looking at how those companies operate on a day-to-day basis and specifically focusing on RevOps and tying all those function areas to work together. This year alone, what are you seeing companies consistently make mistakes on at RevOps and how are you addressing that at Carabiner?
Well, I think so. There's 2 things that I would say. First is the definition of RevOps is often the most flawed place where we begin, right? So, revenue operations is a fast growing movement, lots of change, lots of formative motion here in that, the how do you call it? It's quite challenging to be able to say objectively, this is what it is, and this is, what it will become because it's so new conceptually for many people. particularly once you get out of SaaS, right? And you start talking to folks who aren't in the cultural zeitgeist of the moment and don't really know anything about it. So as a result, you get this weird juxtaposition between, Salesforce administration or tech support or, deal desk management and what should be functionally a very strategic seat at the table to understand what's going on in a business and what moves need to be made in order to better support that business. So if we think about that for a moment, you can be talking to someone, even within an organization, and they can be using the same terms, right? But they mean different things to different people. And therefore you have total miscommunication. So the first bit is just getting on the same page about what this function is, what it's supposed to do for the business that it's in, and what the return on investment of installing those processes and those positions actually will mean for that company. That's something that we see quite often, quite consistently. It's rare that there's an organization that everyone's on the same page when it comes to RevOps. So that's the first bit. The second bit, and more functionally, is there generally tends to be a lack of data governance, but more so than that, a data strategy, right? Everyone's always talking about, we want to utilize our data, we want to collect it, we want to store it, we want to analyze it. But very rarely is there a narrative to that story that actually is geared towards a business outcome. So, a data strategy is a really important part of just running a tech-enabled business in this day and age. And that's generally the outcome that all of these investments in technology are supposed to get us to, something that's more prescriptive, something where you can, look into the future and see with a certain degree of certainty that this action or that action is going to happen, or vice versa, looking into the past and analyzing why did this action or that action happen based off of the data that you have. But in order to do that again effectively, you have to have a defined outcome, some defined hypotheses, and some defined processes that get you from those hypotheses to those outcomes. And again, that's something that is often overlooked by not only the folks who are in the roles, sitting in seat due to all of the other admin work that they have to do, but it's certainly overlooked by the executive teams that are at the top who are sort of dictating what these priorities may or may not be moving forward.
This is going to kind of take a bit of a turn now. And this is a question that we ask everyone that comes on the show. We ask Cliff, and you can be obviously as specific as you would like. Thinking back over the last 5 years, what has been, if you could pin down one thing, the toughest moment in your career, if you had to choose one, how have you dealt with that? And what advice would you have for others that might be in a similar position, not necessarily to avoid those pitfalls, but to better deal with them over time?
Well, I'll give you two answers because one is somewhat unique to me, and I don't know that you'd be able to replicate it, but maybe I guess there is some analogies there. But starting the firm was actually quite a challenge, or maybe not starting the firm, but choosing to follow this firm at its near conception rather than going and working for a big company was actually quite a challenging decision. It was something that I really angsted over for several weeks. I really wanted to go work for that company. I really wanted to go work for Deloitte. I got recruited by a really cool partner. I was going to work on what at the time was the largest Salesforce implementation to ever happen, putting it in across all of Deloitte globally. It was going to be something that was going to be very formative to my career and be an experience where I would have learned an immense amount and gotten to work under some really talented, mentors and people. And it felt like I was letting those folks down in some respect by having accepted an offer and then, rejecting it 6 months before I was due to start. So that was something that I had a lot of just mental stress over. It turned out to be probably, jury's still out, but most likely the best, a good decision. But I guess there's some lessons to be learned there about, taking the plunge and doing the thing that may be hard, even though it can be challenging. And above all else, maintaining those relationships as well as you can. So I actually haven't seen my partner there, my Deloitte partner who recruited me in person since I started the firm. But I've emailed, him a couple of different times and we've stayed in touch over the years, and it's been gratifying to do that. On the flip side to that, I think another challenging moment within the actual career that I'm sure more folks can parallel is we've had to do layoffs before, right? And as a young founder, layoffs are, for any founder, but for a young founder in particular, layoffs are a very challenging motion to do appropriately, particularly as a bootstrapped company. You're not in a position to offer significant severance, if any. You're not in a position to, set people up financially. Usually it's because somebody didn't pay. Ours was because somebody didn't pay us a six-figure sum that they were contractually obligated to do, and we had no real options at our disposal. So given all of that, it was a really challenging motion for us. And for me in particular, I was like, I had made commitments to these people. I brought them into the company. I really cared deeply about their professional and personal successes. And yet we still had to do this thing. And so we've laid all the best laid plans and did all of the different motions that, we needed to in order to be, successful with it. And we executed it and people left and they did their things. But I think I very much got more in my head around this is personal rather than professional, right? This is a business relationship. You can still be friends with these people. You can still do the best by them. One of the things we did was we lined up jobs for most of them on their way out the door so that we could, make introductions and place them in positions that we knew they would be successful in. And within 2 weeks, all of them had new positions because we did all that prep work. But nevertheless, it was one of those moments that was really challenging because that introduces such a degree of uncertainty and tumult into somebody's life, and you don't want to feel responsible for it. Candidly, I don't know that it ever gets easier, but I think certainly doing the prep work and doing the small things, doing the things that you can to make it as easy or easier, providing those resources for folks becomes, much more meaningful and hopefully hopes to maintain those relationships despite the bad news into sort of the next career that they'll be in, the next positions that they'll be in.
Yeah. Great advice for other founders in similar position. Completely agree. This is kind of going to link back to one of the previous questions that I'd ask you, specifically kind of around RevOps. And as you mentioned, it is an embryonic topic, right? Yeah, I mean, obviously this is a SaaS podcast, so more develops than say other industries that I'm sure you deal with on a day-to-day basis. Looking towards the next 5 to 10 years, specifically at Carabiner, as well as the RevOps function, I know obviously this is, as you mentioned on your previous answer, this is an evolving, changing function and topic. So it's going to be difficult to pinpoint what this is going to look like over the next 5 to 10 years. But what are you most excited about in RevOps, thinking about opportunities, innovation, not only Carabiner and your services, but for the broader market impact too?
Well, we're at an interesting point in the RevOps trajectory right now because people don't have the cash to invest in it, but they need it more than ever, right? So it's going to be interesting to see what the function evolves into, without doing too much of a plug for our services, right? Like the whole point is that, hey, maybe you can get 10 hours, you can get along with 10 hours a week instead of 40 hours a week, right? It's 10 hours, worth the investment to get you some of the insights that you might need. And I do think people are embracing that to a degree. But I think it's also a make or break time because with, different actors and different technologies that are in the space and competing with one another and working to define what this movement is, if you get too much bad outcome from it, right, or too much non-return on investment, it's going to kill the movement, right? So there's a possibility RevOps dies in the next 5 years and it doesn't exist, right? Because there's a lot of newbies who are around and, don't necessarily have the experience and therefore could be giving it a bad name. So I worry about that quite a lot. I think where the innovation comes from is probably from the consolidation of the platforms. Everybody's trying to build a RevOps platform right now. And I do think that there is a possibility when we think about insights and analytics that we will see massive consolidation over the next 18 months with new super giants, emerging at the end that are, Salesforce / HubSpot competitive even in terms of the offerings that they bring to the table. So if you think about all of these different point solutions that people have out in the market, if you were able to amalgamate those and lower the cost of goods on them significantly enough to make it, worthwhile investing in them, I do think you start to see the emergence of a new play of rev tech platforms that again become a critical piece of any modern tech stack. The other piece that I think is connected to this is, RevOps today, to your point, is fairly isolated inside of the SaaS market. So if it jumps to medicine, as an example, or if it jumps to financial services in a bigger way than it already has, if it jumps to, hardware manufacturing in a bigger way, right? Like these are the areas I think we all forget that SaaS is an extraordinarily small part of the global economy, despite its very large, mind share and all the people listening to this call. And if RevOps makes that jump, you're going to start seeing a remarkable change in the efficiency of many businesses. And ultimately, it may very well open up SaaS to become significantly more mainstream in the way that it gets applied in the global markets, rather than just being more of an incestuous sort of let everybody sell to each other type of market, which it seems like it sometimes is today.
Yeah, I agree with you on that. When you think about the consolidation of tools, specifically in RevOps, do you think that those benefits is because RevOps in its conception should be something that is looking at the business holistically? You can't have multiple different tools acting within a RevOps function because unless they're not talking to each other. How is that ever going to work? Is that the reason that you think all those tools are good to consolidate, or is it more so something else?
Well, I think there's a combination of it, right? I think we as an industry, a SaaS industry, have gotten very complacent with the idea that there will always be money, right? And I think you may have used the term backwards or some antiquated, right? The other markets. Other markets don't work like that, right? Other markets have a budget, and that budget is defined on what their gross margin is, and then what their operating margin is, and what they're allowed to spend in order to move those lines one way or another. There isn't a magical bank hiding behind a curtain who's handing out $10 million checks to get these businesses off the ground. That's just not how it works. In most instances, defense is maybe a little bit different. So if we consider that to be the case, right? Like if we really take that as at its core, I think there's a lot to be learned from that. If you're going to sell to one of these manufacturing companies, you have to solve a problem. You have to do a pilot. You have to solve the problem, prove that you can do it, and that's when the check comes, right? There's none of this. Let's pay $10 a head for every user in our org to get access to this tool that 15% of the company will actually get value from if it's properly enabled and implemented. Just doesn't happen. They're also not trying to go towards that 200% year over year growth trend that SaaS, people want to accomplish. And so they're much more prescriptive about the way that they spend their funds, because they know that they're not, trying to shoot for the moon. They're trying to shoot for 10 or 15 or 20% operating margin, and maybe 10 or 20, 15%, growth margin. So if we consider all of that, again, like that's a little bit of a different perspective on the world. And what SaaS is starting to, the stark reality, the problem for SaaS people is that they have to start acting that way. And that means they are already, and they will continue to cut spend in areas where they don't feel that it actually impacts their bottom line. And most of these point solutions are nice to haves, not need to haves. Do you really need to have this very niche data enrichment tool that may or may not actually, be part of your sales motion that you pay $20,000 a year for? And $20,000 a year didn't used to be a lot of money. And now it's a quarter of a person's or fifth of a person's rate. And the CFO is going through and just taking a marker and slashing through all these lines. And so the consolidation motion is going to be because these point solutions still may have value, but they can't stand on their own in providing that value. So you're going to need to see consolidation, and that 5-point solutions becomes that platform solution that actually has enough accumulated value that you can afford to pay $15 a head for it, and then, get 10x return on the value prop into the longer term. Right. And so you're artificially manufacturing, if we use the vitamin versus painkiller analogy, you're artificially manufacturing a painkiller by, pushing together 5 vitamins, right? That's the sort of the concept behind my hypothesis there.
Yeah. Humbling for a lot of people, I can imagine, that are listening to this, probably thinking about the same thing, especially over the last year.
I do think that, to your point, humbling. The funny thing is, and just as a quick commentary on the market, right? This is why liquidation preferences in startups matter, right? Because you're going to enter into a market here very quickly where investors are going to push for an exit. Founders will get left high and dry because of the liquidation preferences and where the multiples currently are. But ultimately, that will be deemed a quote unquote successful exit. The investors will recoup their investment. Somebody, whoever's well capitalized enough to do the roll ups, will acquire technology at what is effectively a quote unquote bargain rate. And founders will make fractions of what they were, originally intending to, because they can't raise bridge rounds. They can't raise the capital to weather the storm. I predict that to happen starting in Q4 and continuing Q1 and Q2 of next year. We'll start to see that motion.
Interesting. Fantastic answer, Seamus. A lot to, I guess, look forward to and monitor in the next, year. This is a final question. This is a question given to us by our previous guest, Bridget Harris. So Bridget is the CEO and founder of one of the first, if not the first, scheduling tool in the SaaS space. You can book me. And she asks you, Seamus, what is the number one practical thing a leader can do today that you see doesn't happen that will make an 80-20 difference in RevOps?
Putting the right amount of resources towards it. What I mean by that? I mean that the job is very rarely a one-person job or a one skill set job, right? So what you'll see oftentimes in RevOps and in startups is they're like, okay, we want RevOps. There's this really cool thing that called RevOps, and we're going to do it. So we're going to go and put out a rec for it. And they try and hire a director level or above candidate. And they do that without the knowledge that for this function to be successful, it requires not only the strategic, what are we doing here type of lens, it also requires the functional hands-on keyboard work to actually make this stuff happen, right? So build the function strategically, but also run the operations, build the technology platforms that will support the outcomes that we're driving towards. And we have to remember that the average tech stack pre whatever this motion, economic time was 155 tools, all working in conjunction with one another, all with their different configuration styles, all needing to talk to each other, et cetera. It is very rare, let alone for one person to have the time in order to do both of those functions, but have the knowledge in HubSpot, Salesforce, Marketo, Clearbit, Synchrony, Sixth Sense, Zendesk, right? All of the different platforms that might have been plugged into that, tech monster in order to do it effectively, right? And so people are hiring one person, they're spending their budget on the one person with the expectation that that one person is going to magically solve all their problems. And in many instances, you would be better served not getting the director candidate, being the strategist yourself or outsourcing the strategist or something, and spending the funds instead on 2 full-time analysts or 3, maybe full-time analysts, right? To actually put the hands-on keyboard and to execute a strategy once it's been, determined, or, finding, an amalgamation of people and resources that can help solve the problem rather than going the quote unquote easy route of just hiring a single leader and expecting for them to fill it out, right? Unless you have $500,000 or so that you're going to contribute to this to solve this problem and to build a team internally of 2 to 3 different individuals who, can run, a proper go-to-market operating system. I think hiring the one will almost be more consternation than it's worth. And so having the right resource mix, I think, is the biggest thing towards success in RevOps, where, there aren't that many people who are experienced enough out on the market. I would say there's probably less than 100 globally who have the level of expertise to do it all. And so recognizing that from the outset and properly planning for the fact that that's the case will not only lead to a better outcome for the business, but also, reduce the amount of just friction on your path to getting there.
At what point do you feel it is necessary, if you can pinpoint a specific time in the life cycle of the business, for them to build a RevOps function? Now, I think this is different in SaaS compared to other industries, but where is that sweet spot, if there is a sweet spot, or would you build it from the ground up every time, no matter what the business?
I would say you're probably looking at as early as you can, RevOps becomes, should be a lens at which you look through your business, right? It doesn't necessarily need to be the highest degree of focus, but making decisions about which CRM you're going to be on and how you're structuring your lead to cash process and those sorts of things. I always say, if you don't have the cash, get a mentor, create advisory shares, or something, right? To get people's opinions on how to set this stuff up properly, primarily as a preventative measure for in the future. If you think you're going to be successful, which everybody thinks they will be, right? Why would you build for a motion that you're significantly earlier, in your business offering, than otherwise, right? Build something that has a scalable structure and scalable foundation to it, and you'll save money and time and consternation later. So it's funny, pre again, this economic motion, we'll see what happens, after it. People literally built in budget into their Series B raises to move from HubSpot to Salesforce. You would see it as a line item. They would build in $500,000 into their motion. And the main reason was, when you make your Series B raise, often there's a new CRO hire that comes closely thereafter, right? And most CRO hires at that stage were pushing for, hey, I run my ship off of Salesforce. These are all the strategies that I have, all the motions that I have. It has nothing to do with which platform's better. It's more so just, what are people comfortable with and what can they run their playbooks out of? And if you really think about that for a minute, that is planned obsolescence. That's planned, waste. Where if you were to have taken that 500 grand, taken 100 of it and diffused it over the cost of having Salesforce from the beginning, it's not that much more expensive, I guess, right? So pound wise, penny foolish type stuff, that's just one example. And there are many of them that sort of all combine. So having a little bit more of a 2-year or 3-year vision to where you're going when you make these technical decisions, particularly when folks are signing 2 or 3-year contracts anyways, probably makes, a lot of sense when you're going through what's next for a business like that.
Seamus, they were all of the questions that I had for you today. I really appreciate you coming on the pod. I think that's super helpful for a lot of people listening. For any of those listening, there'll be information about Seamus Carabina all underneath wherever you're listening or watching this podcast. Before we wrap up, Seamus, I know we're coming to time. Is there any final parting words, final comments that you'd like to leave the audience with?
I would say, this is an interesting time that we're all in right now. Check your product, make sure that it's, the right thing that you should be selling right now. Sometimes pivots are the most successful ways to, embrace change and take advantage of weird opportunities like this. And don't be afraid to take a few gambles along the way, as long as they're grounded in something that makes sense. So.
Fantastic. Really appreciate it, Seamus. And to all those listening, we'll see you next week. Cheers.